Ever feel like we're stepping into a secret society? Today, we're cracking the code on company valuations, and we've got another drop from our man on the inside, Allan Smithee. You know, the due diligence detective, keeping his identity under wraps so he can keep spilling the tea.
Right. The guy's a legend. This time he's dropped a stack of notes on comparables. Basically, how do you figure out what a company is worth by looking at similar businesses that have changed hands? Sounds simple, but
It's never that straightforward, is it?
not even close. Allan's notes, they're like a masterclass in why you can't just slap a price tag on a business based on a quick glance at some other deal.
Okay, so for anyone tuning in for the first time, maybe we should back up a bit. Who is this mysterious Allan Smithee, and why should we trust his intel?
Good point. So for the uninitiated, Allan Smithee, total mystery man. Nobody knows who he really is, but we hear whispers. Word on the street is he's worked with some of the biggest players in the game, private equity firms, hedge funds, you name it.
He's seen it all, done it all, and lived to tell the tale anonymously, of course.
Exactly. And he's got a knack for sniffing out those hidden details, those little things that make or break a valuation.
Like what kind of hidden details are we talking about?
Well, he starts by reminding us that most small to medium businesses, when they get bought or sold, it's not exactly front page news.
They like to keep things hush-hush.
Exactly. So even if you're trying to be diligent, it's tough to find reliable data on those deals.
Okay, that makes sense. So even if you find some numbers, how do you know if those supposedly comparable companies are actually comparable? I mean, every business is unique, right?
That's where it gets interesting. Allan's notes highlight a bunch of factors that can make seemingly similar businesses totally different when it comes to valuation. First up, profitability.
Makes sense. A company raking in the cash is going to be worth more than one barely scraping by, even if their revenues are similar.
Exactly. You're looking at profit margins, return on assets, those key metrics that tell you how efficiently a company is using its resources to generate profit.
It's like comparing a finely tuned sports car to, well, maybe a beat-up pickup truck. They both get you from A to B, but one's going to cost you a lot more to run.
Love that analogy. And speaking of running, Allan also talks about growth potential. A company with a bright future is going to be valued differently than one that's plateaued, even if their current sales are identical.
It's all about what's next, not just what's now.
Precisely. Investors are always looking for that next big thing, that company that's on the verge of a breakthrough. Remember that time I sunk my savings into insert a quick, relatable anecdote illustrating a bad business decision based on perceived potential?
Oh, we've all been there. But that's a story for another time, perhaps.
Yeah, betting on potential can be risky business, that's for sure. But Allan, he digs even deeper into this whole comparables game. He brings up synergies. You know those magical moments when 1 + 1 = 3?
Right, like when companies merge and suddenly they're a powerhouse, saving money left and right or tapping into a whole new market.
Exactly. And that, my friend, can make a huge difference in valuation. A buyer might be willing to shell out a premium for a company if they see those synergistic sparks flying.
So even if the numbers aren't amazing on their own, the potential for synergy can sweeten the deal.
Precisely. And hold on, because Allan throws another curveball. He says we've got to factor in the overall economic climate. Like when a deal goes down during a boom time, well, everybody's feeling optimistic, right?
Cash is flowing, everyone's throwing money around.
Exactly. But during a downturn, those valuations, they can get a reality check. Suddenly, everyone's a bit more cautious, a bit more, shall we say, grounded.
It's like the difference between buying a house during a seller's market versus a buyer's market. Timing is everything. And speaking of big players influencing the market, what about private equity firms? Don't they have a reputation for shaking things up in the valuation game?
Oh yeah, Allan definitely picks up on that. He's noticed how private equity firms, they often have a different playbook. They're not always playing for the long game. Sometimes it's about getting in, flipping the company, and getting out quick.
So their timelines, their whole investment strategy, it's different. And that can skew the numbers.
You got it. They might be willing to pay top dollar for a company, even if that price tag raises some eyebrows in the market.
So we've got profitability, we've got growth potential, synergies, the economy, those private equity power moves. Allan's really painting a picture of just how many variables are swirling around in evaluation. And of course, we can't forget the human factor, right?
Oh, absolutely. As Allan reminds us, behind every spreadsheet, every financial model, there are people making decisions. And people, well, let's just say we're not always perfectly rational creatures.
Emotions, biases, gut feelings, they all come into play.
Exactly. And sometimes Even plain old bad judgment rears its ugly head. And you know what? This actually ties into a really interesting point that Allan makes about public company valuations.
You mean like those big companies trading on the stock market? I always figured those valuations would be the most reliable, the most, I don't know, official.
You'd think so, right? All that transparency, all those regulations. But Allan, he argues that even those public company valuations, they can be misleading.
Really? How so?
Well, for one thing, public companies are playing in a whole different league than most private businesses. They've got armies of analysts scrutinizing their every move. They're beholden to a whole other level of public scrutiny.
It's a different ballgame altogether.
Exactly. So trying to compare a small, privately held company to a publicly traded giant, it's like comparing apples and, well, I don't even know what. It's not even fruit.
Okay, that makes sense. It's like trying to compare the value of your neighbor's house to, I don't know, Buckingham Palace. Sure, they're both buildings, but come on. And while we're on the topic of potentially confusing comparisons, Allan throws in another curveball, those industry classification codes, the SIC codes, the NAICS codes.
Ah, yes, those codes. They seem straightforward enough, but even seasoned professionals can trip over them.
I'll admit they've always been a bit of a mystery to me. Like, I get the general idea, but how much weight do they really carry in the whole valuation game?
More than you might think. Allan's point is that even companies lumped into the same broad industry can have wildly different business models, target markets, growth trajectories, the whole nine yards.
So just because two companies share a code doesn't mean they should be valued the same.
Bingo! It's like assuming that a Michelin star restaurant and a fast food joint should have the same price tag just because they both serve food. You've got to look beyond the label, understand the individual strengths and weaknesses, and consider how those factors influence the value proposition.
Okay, that's a lot to unpack. So if we can't rely solely on these comparables, those market reports, or even those official-sounding industry classifications, how do we make sure we're not getting fooled?
Well, that's where things get really interesting, and it's a topic for another deep dive, wouldn't you say?
Oh, you're good. Always leaving our listeners wanting more. Okay, you've definitely piqued my curiosity. But before we dive into those other valuation methods, let's bring it back to comparables. If we can't rely on them completely, how do we use them effectively without getting tripped up?
Well, Allan, he's all about context. Don't just blindly throw multiples around or take someone else's data as gospel. You got to understand the ins and outs of that specific business, the market it's playing in, the whole nine yards. Then, and only then, can you use all the info you've gathered, including those imperfect comparables, to make a judgment call.
It's like being a detective, right?
Yeah.
Gathering evidence, looking for inconsistencies, never taking anything at face value.
You got it. And here's where Allan throws in a real doozy, a cautionary tale about, of all things, the Vlasic Pickle Company. Apparently, there were some serious questions about how comparables were used in their valuation, and let's just say it didn't end well.
Hold on, Vlasic pickles. Like the ones you put on a burger. What happened there?
Well, it's a bit of a rabbit hole, but the short version is the comparables used to value Vlasic, they weren't exactly a perfect match. They didn't really reflect the company's financial health or its position in the market.
So someone was playing fast and loose with the numbers, trying to make a deal look better than it really was.
That was the allegation, and it turned into a whole legal and financial mess.
Yikes. Talk about a pickle. But it just proves Allan's point, right? You can't just slap a comparable on something and call it a day. You have to connect those dots, see the bigger picture.
Absolutely. Valuation, it's not just about crunching numbers, it's an art and a science. And sometimes you need a bit of that detective work to uncover the truth. Speaking of which, we're nearing the end of our deep dive. But before we wrap up, Allan left us with one more thought to ponder. He mentioned that larger companies often have higher valuations multiple-wise compared to their smaller counterparts. Is that always the case, or are there exceptions?
It's a pattern you see a lot. Think about it. Bigger companies, they usually have those established brands, a wider reach, easier access to capital. All those things make them more attractive to investors.
So it's not just about their size right now, but it's also about their potential to leverage that size for future growth.
Exactly. Investors, they're looking for that perfect balance of stability and growth potential. A larger company that's still got room to run, that can be a powerful combination.
Makes sense. But I'm guessing there are always exceptions to the rule.
Of course. A small, agile company in a hot market. They could easily be valued higher than a lumbering giant in a declining industry. It all goes back to context. Context is the name of the game, isn't it? We have to remember, these comparables, these rules of thumb, they're just tools in the toolbox. Helpful, yes, but they shouldn't be calling the shots. We have to do our own due diligence.
Couldn't have said it better myself.
So as we wrap up this deep dive, remember, when it comes to valuing businesses, comparables can be misleading. Don't just skim the surface, dive in, question those numbers, and always keep digging for the truth. Until next time, happy hunting.